Have you ever noticed something strange happening in the silver market? Prices in Shanghai are soaring, sometimes reaching $17 higher per ounce than in New York. What on earth is going on? This isn't just a small blip. It's a massive signal that something big is shifting in the world of precious metals. Today, we're diving deep into the great silver squeeze, uncovering why Shanghai's silver is so much more expensive, and what it means for you as an investor or just someone curious about the global economy. So, what's the big deal with this price gap, also known as the arbitrage spread? Normally, the price of silver is pretty consistent across major global markets like London, New York, and Shanghai. If a significant price difference appears, traders usually jump in, buy low in one market, sell high in another, and pocket the difference. This action, called arbitrage, quickly balances the prices back out. But right now, that's not happening. The spread between the Shanghai Futures Exchange and the COMEX in New York is stubbornly wide. This tells us there are some serious frictions in the market, preventing the normal flow of silver from west to east. Let's break down the key reasons behind this phenomenon. First and foremost, we have incredible physical demand coming from China. Think about it. China is the world's manufacturing powerhouse. They need silver for everything, from solar panels to electronics, and their demand is relentless. The country's push towards green energy and high-tech manufacturing means they're consuming silver at an unprecedented rate. This isn't just about investment, it's about industrial necessity. When a nation of 1.4 billion people needs a resource, it's going to put a massive strain on global supply. On top of that, there's a growing movement within China of individuals buying physical silver as a store of value. With a shaky real estate market and a volatile stock market, many Chinese citizens are turning to precious metals to protect their wealth. One major hurdle is logistics and regulations. Moving large quantities of physical silver across continents isn't as simple as clicking a button. It involves transportation, insurance, and navigating complex import-export rules. These processes take time and add costs, making it harder for arbitrageurs to profit, especially when the market is volatile. Another critical factor is the nature of the Western silver market, particularly the COMEX. A large portion of the silver traded in New York is paper silver. These are futures contracts and other derivatives that represent a claim on silver, but not necessarily the physical metal itself. The amount of paper claims often far exceeds the actual physical silver held in the vaults. So, while the paper market might suggest there's plenty of silver, the physical market tells a different story. There's a growing disconnect between the paper price and the price people are willing to pay for the actual metal in their hands. This brings us to the core of the squeeze. The high prices in Shanghai are a reflection of a tight physical market. Buyers in China are willing to pay a significant premium because they need the real thing, not just a paper promise. They are essentially calling the bluff of the paper markets. They need silver for their industries and for their savings, and they're paying what it takes to get it. This situation is exposing a potential weakness in the Western pricing mechanism, which is heavily reliant on derivatives. What does this mean for the future of silver? This widening spread could be a leading indicator of a major repricing of silver globally. If the physical demand from the East continues to outstrip the available supply, the paper markets in the West will eventually have to catch up. The price you see on your screen, the spot price from COMEX, might become less and less relevant if you can't actually buy physical metal anywhere near that price. The real price is what someone is willing to pay for delivery, and right now, Shanghai is showing us that price is much higher. This isn't just a Chinese story, it's a global one. Other countries, particularly in the BRICS alliance, are also increasing their holdings of physical commodities as they move away from the US dollar-centric financial system. This broader geopolitical shift adds fuel to the fire. As more nations prioritize tangible assets over paper claims, the demand for physical gold and silver is likely to intensify. So, what should you do? This isn't financial advice, but it's crucial to understand these dynamics. The Shanghai Premium is a powerful signal that the physical silver market is much tighter than the paper markets would have you believe. It suggests that the true value of physical silver might be significantly higher than the current spot price. Pay attention to the premiums on physical silver coins and bars in your own region. If they start to rise, it's another sign that the squeeze is tightening. We are witnessing a fascinating tug of war between the paper markets of the West and the physical demand of the East. The massive price difference between New York and Shanghai isn't just a market anomaly, it's a symptom of a much larger shift in the global economic landscape. The demand for tangible assets is growing, and the pricing power is slowly moving eastward. The Great Silver Squeeze is revealing the cracks in the old system, and it could be the prelude to a very exciting time for precious metals. Keep your eyes on the spread. It's more than just a number. It's a story about supply, demand, and the changing world order. The days of cheap, readily available physical silver might be numbered, and the market in Shanghai is screaming that message loud and clear. Thanks for watching. If you found this breakdown helpful, make sure to hit that like button and subscribe for more insights into the world of finance and precious metals. Let me know in the comments what you think about the silver squeeze. Is this the beginning of a major price breakout? I'd love to hear your thoughts. Until next time, stay informed and stay curious.